Welcome back, everybody, to the weekly market review for the week ending May 17th, 2024. And the question is there anything to be concerned about anymore in markets? And we'll jump into that in just a little bit. I just want to remind you to hit the like button and subscribe to the channel. You can also find me on Twitter at Mr. J. Thomason. And you can follow my free weekly newsletter at befinanciallyfree.substack.com. The links to both my Twitter and the Substack are in the description of the video below. I do want to say that this last week's call on the week ahead was not accurate. It's only I think the third time in 2024 where the directional bet was not accurate. So definitely want to be as transparent about that as I am when I talk about when I made a good call. And so just wanted to mention that. But you're always going to see it as you're always going to get it the way I see it. So let's see, where was it? So yeah, my thought on this was that I did say uncertain direction, but I had a downside bias, and that had a lot to do with the upcoming inflation data, which has been coming in hot for the last couple of months. But there were a couple of developments that kind of changed the narrative surrounding inflation, and we'll talk about those in just a second. But basically, market participants this week got basically everything that they could ask for in terms of developments that would elicit maybe dovish responses from the Fed, or the potential for more dovish responses from the Fed. And so I want to kind of dive into those things. But first, before we do, we'll take a look at the just kind of where the markets are at right now. The S&P futures, I look at it on the futures, but we did close this week at all-time highs. We had an all-time high close on the daily on Wednesday. But in terms of the weekly close, we are also at an all-time high on the weekly candle. So I do want to highlight that. Obviously, there are a lot of people out there trying to pick shorts. I mean, basically, for a long time, people have talked about the fundamental and macroeconomic stories that should lead to a decline. And it's not that I'm saying that any of those things are wrong in theory, but of course, the markets can be irrational, and there are lots of factors that go into market pricing. There's definitely psychology and things like that go into it. So suffice to say, I was wrong on my call. I don't know if I have the boxes up here still. So a long time ago, not a long time ago, back in April, the beginning of April, we had a couple of reversal candles that I was pretty transparent about on Twitter. I might have even talked about it on this channel. I don't remember if there was a couple of times I didn't post videos, but anyway, I had started to look for downside targets. So I used a combination of different things. I looked at horizontal levels of support. I looked at the tide line here, the trajectory of the tide line. I looked at Fibonacci levels and things like that. And I came up with these three boxes. And my base case was that we were going to see 7 to 10%, which basically was getting down to the second box here. We did not make it there on this move. I thought that we might, but I could show you a couple of different things that I was looking at, but that obviously did not take shape. We got a little bit less than, I think it was barely under 7% on this pullback. If you go from the intraday high to the intraday low, 6.94%. So we were close to my 7% down, but didn't exactly get there. So I'm not going to try to take credit for being that close, because I was still wrong. But in any case, the markets have gone on. This reminds me of a couple of different things. There were a couple of different scenarios I had been looking at. I was looking at the summer 2023 scenario for the correction, just maybe a little bit longer and a little bit deeper. That's another way I was able to place those boxes. And then another paradigm that I had started looking at was from back in 2021. So we had this pullback in 2021, which was nearly the same in terms of its depth, if you go from the intraday high to the intraday low, just a little bit less of a decline. Let's see here. There we go. Very similar in its, in the angle and the trajectory to the downside. And this one melted up and took off, but it obviously was heading into kind of the rounding top into 2022 before the bear market. So that was a paradigm I was potentially looking at. It looks very similar right now to that, but of course not exact, and I'm not trying to suggest that that is going to happen. Another paradigm I was looking at was some of this price action looked pretty similar to, particularly over here, kind of at the middle of last week. It kind of reminded me a little bit of what was going on here after that we hit the low of the correction last year in the summer and in the early fall, because what happened was price shot up really fast, had kind of this moment where it looked like it was going to roll back over, caught support, and then took off. And so basically, I did a couple of different patterns here. Let me put this on that chart. And so what I did in this, let me see if I can straighten this out a bit. So the yellow was the summer 2023 correction, extended a little bit and then overlaid. The blue is the late 2021 pullback that went into the end of the year strong and then rolled over and went into the bear market in 2022. That's the blue. And then the pink is basically from that little bump that I was talking about right after the summer correction. And so, obviously one of these scenarios does not look like, one of these scenarios is done. So I'm just actually going to delete that. Two scenarios are left. And of course, these are just fractals. It doesn't mean it's going to happen this way. I'm not saying this is my base case, but if we want to get an idea of what could happen, we have historical precedent for both of these happening. One of them involves getting up to somewhere between 5,500 and 5,600 before rolling over. And again, not saying that we will. The other one, if we have a run similar to what happened from the October lows to before we just had this most recent pullback, then we could be looking at S&P 6,000 by September. And that would just be wild. And everyone, frankly, there's a part of me that wonders if that's going to be what actually happens. Because at this point, it's like, well, nobody thinks that this could take place. It almost, people couldn't believe, and to a degree, myself included, couldn't believe the price behavior from October to, the beginning of April. Who's to say that couldn't happen again? I think we should all be aware of that possibility. So I'm going to turn these off really quick, and I want to show you. I want to go back and show you. I'm going to have to show you on SPY on the ETF, but I do want to show you. And pardon my lines. I was doing something with those, but I want to go back to pre-dot-com bubble. There have been some people who have likened what's been happening now to the dot-com bubble. So if you go back, this was when the Fed cut rates right before the kind of the 95 to 99 run in prices during that bull market. And so you actually have it goes straight up, has a pullback, goes straight up, has a pullback, goes straight up, has a pullback, goes straight up, has a bigger pullback, goes straight up, pullback, go straight up, and then that's the top. And that went on for 5 years. And so it's entirely possible that something like that could happen. So everyone would be in disbelief, and that's part of why I kind of feel like it could happen. In any case, that's the S&P. The NASDAQ, I can get rid of these because the NASDAQ has broken out from its levels, and it has not closed. We'll say it has not closed above. Let's see. I don't know. Did we get there? So I have a lot to say about March 8th. I'll talk about it in just a second. So the high on the futures was 18,691.25. The close was the close was higher. No, that's actually the high. Let me see. The close was 18,691.75. 691.75. Okay. So yeah, this actually did close higher. So I just wanted to make sure I confirmed that before I continued. NASDAQ also closing at all-time highs. Russell not closing at all-time highs. Has not made a new high yet. That remains to be seen, but it is above currently the resistance level from our little channel, the upper resistance level, I should say. So it's entirely possible this could take off. It does not look like the Russell will decline to these boxes that I had originally put here. I'm gonna get rid of. Oops, I don't think that was the thing I wanted to get rid of anyway. Get rid of that. There we go. Sorry, doing this in real time here. We had the dollar. Oops, let me go to the dollar. The dollar has been coming off for a little bit. The dollar is closing in kind of the no man's land. If you followed this channel for long enough and you know what the tide line is, my tide indicator, this area between the tide line and the control line, or I also in my newsletter call it the current line. It's kind of in the middle there, looking for direction. It's going to make a big difference the direction that this goes in. If it goes more to the upside, then it suggests the uptrend can continue. If we close below the control line and we keep going down, then that's going to suggest that we could be in for a bearish cross, and that's obviously going to be net positive for risk assets. Looking really quickly at the 10-year, I thought this was interesting after the sell-off. After the cool down in yields, we actually did close back above the tide line. And so this is actually poised to continue to move to the upside. So that's really interesting, especially when you consider the damage done to the 10-year yield because of the PPI on Tuesday and the CPI on Thursday. Obviously, Bitcoin has had a good couple of days, good week. Let's see, Bitcoin is up almost 10% on the week. Gold had a really good day and has also had a pretty strong week, up 2.3% on the week. Silver had a really good day, and silver had a really strong week, up over 11%. This one I didn't get this one right today. It appears that silver is breaking out just like gold did a long time ago. The difference, I guess, with silver is that it is not at all-time highs. It's not even close to its all-time highs. And one of the thing that I was wrong about, at least as far as today was concerned, I wondered if silver would give up its gains during the day. But if you actually look throughout the day, let me get rid of the tide for a second. Silver had already gotten up pretty strong. And it was right around here where I was wondering if price was going to fail and go to the downside. And silver is really crowded, so I was looking for that as a potential short. And part of the reason I was looking at that, not just from the crowdedness on the futures, but also just because of the sentiment. And maybe I'm the one. Maybe it's my fault that silver went up today. I don't know, but I even tweeted, I used one person as an example. Didn't mean to call the person out or suggest anything negative about them, but one of the things that I was looking at was how pretty much once we broke 30 today, everyone was talking about how 50 was the next place. So everyone's talking about silver going to its all-time high from here, increasing by $20. And usually when the sentiment gets that frothy, that's usually, in my opinion, a signal to look for it to go the other way. My best example that I can give you is back, I talked about this on this channel before, back in April of 2023, right here when everyone was talking about, gold's going to go to 2,500. I started hearing that. Peter Schiff was on Jordan Peterson's podcast talking about gold, how it was going to go up like imminently, and I started talking about going the other way. And of course we got, a really long protracted, let's see, from that spot, it was like right around there. And we ended up dropping 10%. It took half a year for the price to go down. And then, we ended up making an all-time high, but it's now it took until February of this year for gold to really get moving. So all that is to say that like the sentiment in silver is really, really frothy. And there's a part of me that's like, well, I mean, a lot of people say, oh, because gold did this, silver must also do this. And it doesn't have to. Silver is completely different for a lot of different reasons. And so I'm just saying that I get really cautious, and this doesn't mean that I have to short this, and I did not short this today, but I'm just saying just because I'm not a fan of it doesn't mean that I have to go short or that I even have to express that view in an actual trade. But I'm just saying you have to watch out when people start talking about things in terms of certainties. And when you have like the biggest thing for me too is like like a lot of retail doesn't want to buy gold because it's $2,400, whereas they are really interested in buying silver because it's only 31. To use a different example, you could look at the GLD. The GLD is $223. SLV is $28, right? And here's what's wild. SLV is barely above the levels that it was at in 2020. And that's kind of the problem. This is like to me, one of the things about the sentiment all across FinTwit. And that's because like a lot of people online, basically what they're saying is, oh, silver and gold have to have a certain ratio. There has to be X number of dollars to gold and X number of dollars to silver. And that ratio between those has been historically consistent. And so people are saying, oh, like that means silver has to go up to a certain level. And you just have to be really careful because what that does psychologically, I think that a lot of this, I think that the silver run right now, because like copper is also running too. Let me go to my futures charts for a second. Let me see if I can find it. I just moved around my thing today. Copper has been going big too. Some of the big news this morning was that China is actually now starting to bail out its property sector even more. So China is doing a whole bunch of stuff with liquidity. So that I think that's part of the reason why the metals, particularly silver and copper, are going up. But I think with silver specifically, there are so many people trying to ape into this because psychologically they're like, gold's too expensive, but I think it's going to go up. Silver is cheaper, and in theory that could go up a lot more than gold. Like it's got a higher beta than gold. So I think that that's a lot of what's driving this. And the problem is when you start buying, I'll call silver the laggard because it did lag. It has been lagging gold up until recently. It has been lagging gold. When you buy the laggard expecting that it's going to catch up, it tends to, if it may play a little bit of catch up, but as soon as the market sells, this thing is going to get crushed. When this market has a pullback, silver is going to get crushed. And it's probably going to pull back at an opportune time. The market doesn't usually tell you, it doesn't tell you ahead of time when it's going to go down. So anyway, so what are the catalysts? I mean, that's kind of just a quick look around the markets. By the way, side note, crude oil. I wonder how everybody who was buying, crude oil in April when everyone was convinced, oh yeah, this is the real move in energy. I wonder how they're feeling right now. I mean, crude oil is still nothing to be excited about at this particular juncture. Although I will say it is in bullish tide, and this is typically in a bullish tide the opportune moment. But the tide signal is telling you that there's counter trend momentum. So once the colorful line turns yellow, if it does indeed turn yellow and price continues to go back up, that would be a better signal. Just like right here. So if you look, tide was actually bearish in this case, but it turned yellow. That was actually the right time to buy. That showed that the momentum was changing. So just mentioning that. So what were the catalysts for the market today? Well, we had the PPI, which came in hot, but there was a revision. Actually, let's see if I can find the revision. Let's see. Can't find the where the revision was. I did not look up where the revision was in this before I got on. Anyway, if I had my other charts up, I could show you, but basically they revised the previous PPI number. So if you guys remember, let me go back to the chart here. So back in, I think it was back last month in April, you had a hot CPI and a hot PPI. And although the market did go up on the PPI, it was hot and everyone was getting a little worried. Well, in this PPI release, they revised back down the previous one, and it actually was negative month over month instead of being positive. Sorry about that. That got the markets really excited. So you can actually see on Tuesday this week, the market. Let me go to the 10-minute chart. You can see this really well on this chart. So if I go back to Tuesday, so at the market actually. Sorry, that's Wednesday. So on Tuesday, you can see at 5:30 the PPI released, and the PPI was, because the headline number was hot, you saw the sell-off. But then people started to digest the fact that the previous numbers got revised down, and then it recovered. And then it looked like it might fail, but then it didn't. It just like rocketed up into the end of the trading day. And then we got the CPI. The CPI was basically at target, except I believe one of the numbers came in slightly below expectation, which is largely about rounding more than anything else, which a lot of people make a big deal out about that. But this also rocketed up and just never looked back. So that was really helpful. And then on Thursday, we got jobless claims data, which jobless claims came in higher than expectation. Not super high, but higher than expectation. Not as high as last month. Again, I don't have the specific charts to show you. But anyway, the market kind of sold a little bit, but then it ended up going up. And then, of course, if you were paying attention in the market yesterday, we got a sell-off. So again, CPI, we got the CPI here. This was the jobless claims data. So you had the previous week's level revised up, and on the initial claims. And then today we got the release for the leading economic index, and you see that it continued to fall. So it decreased by 0.06%. After decreasing by 0.03% in March. So they have this really helpful graph. And what's really interesting is there is a huge disparity in what happened. So we had the year-over-year change. This chart is super interesting because it kind of, let me zoom it out really quick. Because you can see that as the leading economic index declines and rises, it tends to correlate pretty strongly to changes in real GDP, and yet it didn't seem to, that correlation didn't carry in 2023, and it remains to be seen kind of what's going to happen now, because it's been going up, but then real GDP is kind of curling over. So that's something interesting to look at. And then when you go to the, where is it? The coincident index rose by 0.02%. This has been something that I track a lot. I'll probably be putting it in my newsletter this weekend. But that's obviously been something that has been a bastion showing the strong U.S. economy. The lagging index was also up. It has continued to be up over time, and so again, currently the economy is strong, despite the fact that you see the leading indicator going down, and that's kind of like I showed you this. I was showing you my newsletter earlier. The headline here: soft data is still important, and it might mean things get worse. So there are leading indicators, such as the Conference Board leading indicator. There's soft data like the survey data from University of Michigan and all that. And those things are pointing to softening, which is really interesting. But the biggest thing is we are and have been in a situation for a long time where, because the Fed raised rates, because the Fed had raised rates so fiercely and quickly, and had been doing QT, the market has been anticipating and looking forward to the day where Fed policy got easier. And of course, the big thing was back in December when they had kind of the verbal pivot. Stocks continued to take off, risk assets continued to take off. At that particular moment, that was when, if you remember, that was when gold really took off. Was around the time of, let's see, right around the December pivot. So maybe not gold. Gosh, what was it? Maybe it was Bitcoin. I can't remember honestly, but there were certain assets that took off following that verbal pivot, and the market has been anticipating this for a long time, and the market has continued to love the strong economic data, but that was obviously bad when yields were coming up, as it was last summer, and then as it was in the month of April. And so the market has been anticipating when inflation data was going to come down, and or when growth was going to come down. So the moment like that, it was back here when we got that Friday jobs report at the beginning of this month, where the labor market data was weaker, and kind of all of the data since then has shown weakness, meaning we're seeing increases in jobless claims. We're seeing the soft data, the ISM, the confidence surveys showing contraction and showing pessimism for growth. So that the market has liked that, because we're in this bad news is good news environment. That's, I guess, the point that I was trying to make for a lot of this time, because bad news about the economy suggests that the Fed can take its foot off the brake pedal and maybe consider easing and cutting and things like that. So, and then now we got inflation data this month, the CPI and the PPI, which provided somewhat of good news on the inflation front, despite the fact that inflation expectations 1 year ahead, according to the University of Michigan survey, are actually it's actually going up. The market, it really loved the soft CPI and soft PPI, or the PPI revisions, I should say, and then the soft CPI data. Those were welcomed additions. And then I think was it yesterday or the day before, so Wednesday or Thursday, we also got retail sales data that was weak. And so right now we're in that stage again where the market is getting really excited about the potential for Fed easing. And that's why rates, bond yields have come down, right? And honestly, to me, in my opinion, this is a story of bond yields, because basically, when bond yields stopped going up, so once you started to see in mid-April bond yields not going up much further, and then actually starting to come off, that was when the market turned back to the upside. And of course, the Fed has done a lot to help that by talking about how they were going to reduce the balance sheet, taper the reduction of the balance sheet, and all that. And how they are still erring on the side of cuts and basically taking rate hikes off the table, or any additional rate hikes off the table. They continue to claim that financial conditions are restrictive and tight, but, well, let me put back up the copper chart again for a second, if I could find it. I don't know. Does that look like a tight market? Not really. What was I looking for? Does this look like a tight market? No, I don't think so. Does this look like a tight market? No. Does this look like a tight market? No. Bitcoin is down, but the last couple of days, does this look like a tight market? No. Does this look like a tight market? No. GameStop? I know GameStop has been coming down for a little bit, but does this look like a tight market? Does this look like a tight market? I don't know. Some of these I don't know. Let me see. Carvana. Does this look like a tight market? Goodness gracious. Anyway, all that being said, the last thought that I want to leave you with, frankly, as long as economic growth doesn't substantially recede in a really, really negative way, and as long as the inflation data is starting to behave, asset markets have the green light in terms of the economic data because it has the support of the Fed behind it. And asset markets appear to have the green light to go up. There is one thing that I would like to just mention. The Qs, they made a new all-time high, but I want to throw up semiconductors. So I made a big fuss about this. Semiconductors on March 8th, a month before the rest of the market started to come down, they had a giant outside reversal day. And the market, despite the Qs and the S&P making a new high above, like above everything, intraday and closing high, the semiconductors have not made a new high. And NVDA specifically, the big darling, has not made a new high above the wick from that, above the intraday high from March 8th. So NVIDIA's earnings are this Wednesday. It's entirely possible that this thing is about to explode to the upside, go over 1,000, and then take the whole market with it. But I just think it's interesting that despite, I mean, the NVIDIA had a 22% correction, so I know that in terms of like performance from that bottom, so let's see, this was Friday, April 19th. From that bottom, NVIDIA is up 21%. So I know that it has outperformed in percentage value, but in terms of the technicals, this is something that I just want to throw out there. It doesn't mean that it's going to triple top here because there's no such thing as a triple top, but I just think that it depends on how you look at it. Either you are looking at NVIDIA and saying, well, the last couple of times, well, no, that's not even true. I feel like I just saw a video where somebody said that the last time NVIDIA earnings came out, it crashed, like it broke down. That's not actually true. Actually, I can't remember. I don't know the last time that happened to NVIDIA. In any case, I think a lot of people are suspecting NVIDIA is going to beat earnings and that it's going to take off. So it's possible that a lot of people are already positioning for that. So then the question is, if they do beat, then what will price do? And then it's also possible that some people might be like, oh, I'm going to sell ahead of the earnings, in which case you're creating a lot of potential energy for NVIDIA to really take off. I'm not really sure what's going to happen, but like this is just something I want to bring up because until, in my opinion, I know that the S&P closed at all-time highs, but you want your leadership to, like people will talk about rotations, but like kind of part of the reason that markets are where they're at is because of the AI story and semis leading that. And if you don't get semis or leadership from the semis, to me that is something to be cautious about. Not to be bearish or not to short, but to be cautious about. So anyway, that took me a long time to get out. Sorry about that. I'm way over the time that I normally go, so I'm going to stop this here. Thank you for tuning in if you stuck around for this long. I hope you guys have a great weekend, and we'll kind of see what happens next week. I'll see you guys next time.